Welcome to the Deep Dive. Today, we aren't reviewing a successful product launch or, celebrating a quarterly beat.
Yeah,
We are launching a full-scale true crime investigation.
that's exactly what this is.
And the victim. The great AI stock boom, which just weeks ago propelled Nvidia to the status of the world's most valuable publicly traded company.
And the scene of the crime is, well, it's covered in blood, financial blood, that is.
A lot of it.
We are talking about a market shockwave so intense it wiped hundreds of billions of dollars off Nvidia's market value in what felt like an instant.
In an instant.
All following some very high-profile competitive news and just really aggressive selling by institutional funds.
This wasn't a slow leak, right? This was a sudden collapse. We watched Nvidia shares plunge 4.6% in a single day.
A single day.
And that extended their month-to-date decline to over 15% as of, November 2025?
That's right. And when a company that basically defines an entire technological era experiences that kind of volatility, the market panic is palpable.
It's more than palpable. It signals that the AI gold rush, this thing we all thought would go on forever, might have just hit a sudden, very hard wall.
And it immediately raises the specter of the 1999 dot-com era. The comparisons are, frankly, terrifyingly accurate when you look at the metrics.
It's not just a feeling.
Oh, no, not at all. We have economists like Torsten Sleck, for example, who's been running the numbers.
And what did he find?
He's concluding that the top 10 S&P 500 companies today are actually more overvalued based on their forward-looking growth multiples than the top 10 were during the tech bubble in the mid-1990s.
Wait. More overvalued than in 1999?
More! That's a staggering data point, isn't it?
It's unbelievable. Because the foundation of this boom feels so legitimate, the technology is real, we see it every day. But you're saying it might all be built on speculative sand.
Precisely. If the market is valuing the current AI giants more optimistically than it valued, say, Microsoft and Cisco back in 1999, we have a structural problem.
What kind of problem?
The expectation that's baked into the price is perfection. And not just perfection, but perfection multiplied by exponential growth indefinitely.
So there's zero room for error.
Zero. The moment that expectation is challenged, even slightly, you get the shockwave we just witnessed.
So our mission today is to figure out what happened. Was this bubble just a necessary market correction? A natural letting off of steam?
Or was it actively murdered?
Exactly. Murdered by internal betrayal and some kind of stealthy new technology. We are tracking three key suspects, three separate forces that seem to converge all at once to cause this massive market volatility.
Okay, so suspect number one. We're investigating the traitor. This is an attack from within Nvidia's core customer base that completely shattered trust and opened a critical competitive door.
Okay, the traitor.
Then we're tracking the alarms. This is the massive coordinated flight of smart money. The titans of finance who clearly knew something was fundamentally wrong with the valuations and got out.
They smelled smoke.
They smelled smoke and ran for the doors. And finally,
Suspect number three.
we are hunting the silent killer. This is the big one, the structural threat. A stealthy new technological breakthrough that fundamentally undermines the entire high-cost hardware model that Nvidia built its kingdom on.
Wow. Okay, so where do we start our investigation?
We start with the most dramatic act, the ultimate corporate backstabbing.
The betrayal.
The betrayal. And it came from Nvidia's own most important customer, Meta.
This is truly high-stakes corporate drama. I mean, it's straight out of a boardroom thriller.
It really is. And to appreciate the severity of this betrayal, we need to anchor ourselves in Meta's relationship with Nvidia. Meta isn't just a customer.
No, they are one of Nvidia's largest and most crucial clients. They're absolutely vital to the GPU maker's profitability.
And their reliance was total, wasn't it?
Completely. We know Meta was heavily committed to the Nvidia ecosystem. They were planning to stockpile a staggering 350,000 of the high-end H100 GPUs by the end of 2024.
350,000, just let that number sink in.
And that would bring their total holdings to nearly 600,000 H100s. We're talking billions upon billions in committed spending.
For all intents and purposes, they were a captive market.
Totally captive, fully reliant on Nvidia's hardware and, crucially, its proprietary software stack.
Exactly. And what do loyal captive customers do when they feel their vendor is maybe overcharging them or restricting supply?
You start looking around?
They start looking for alternatives in secret. And that's when the news broke. Meta is now in deep talks to buy billions of dollars worth of Google's custom chips. Their tensor processing units, or TPUs.
This is the definition of a backstab.
It's a total backstab.
So why is this such a fundamental shift? I mean, Google's had TPUs for a while, right?
Right, but for years, Google kept its TPUs exclusively inside its own cloud facilities. They were a proprietary advantage.
Their secret sauce.
Their secret sauce. Now, they're selling them externally. They are effectively transforming Alphabet into a direct, large-scale hardware competitor in the AI semiconductor space.
So Google is now competing with its own customer in a way.
Well, competing with its customer's biggest supplier. And this shift is enormous, not just for Google, but for the entire hardware supply chain.
And the timeline here is key, isn't it? It shows how urgently Meta wanted this.
It shows the urgency. The timeline of the betrayal reveals it all. Meta is considering deploying these Google TPUs in its own data centers starting in 2027.
Got it.
But even sooner, they may rent TPU capacity directly from Google Cloud as early as next year.
So this is happening now.
This tells you they need diversification now, not in 3 years.
But let's ask the crucial question here. If Meta is projecting, capital expenditures of $70 to $72 billion this year?
A massive number.
Is buying a few $1 billion worth of Google TPUs really a betrayal? Or is it just smart risk management, for a huge infrastructure buyer that just can't rely on one vendor?
It's both. And the market confirms it's a betrayal by its reaction.
Also.
When the news broke, Nvidia shares fell about 2.59%. At the same time, Alphabet shares rose 1.53%.
Okay, so the market priced it in immediately.
Immediately. The market recognized this as a successful encroachment. For Nvidia, this isn't just about lost revenue, it's about lost leverage.
Right.
When you are the only game in town, you dictate price and supply terms. The moment your largest customer begins building a parallel supply chain with your most aggressive competitor, your leverage it evaporates.
And the immediate motivation for Meta is pretty clear. They're trying to reduce their dependency on Nvidia's constrained supply and, maybe more importantly, its really expensive GPUs.
Exactly. And analysts estimate the projected damage here is incredibly direct. If this strategy with Meta and other hyperscalers is successful, Google could seize approximately 10% of Nvidia's annual revenue within a few years.
10%. That's a direct hit to the chip king's future growth prospects. It's not a rounding error.
And that 10% figure, I'd argue, is conservative. It sets a dangerous precedent.
Because everyone else is watching.
Of course. Other major customers, Amazon, Microsoft, even startups, they're all watching Meta's move. And they know that custom silicon, like the TPU, is generally much cheaper to procure and operate at scale than a general-purpose, high-margin GPU from Nvidia.
You can really see how threatened Nvidia is just by watching CEO Jensen Huang's countermeasures. I mean, he's been aggressive.
Oh, he's the undisputed king of this market, and he is clearly not taking this strategic attack lying down.
Not at all.
He's been actively engaged in this high-stakes counter-marketing, conducting technical reviews, offering enormous strategic deals. He's treating this like a turf war, not just a business negotiation.
He's essentially brought a cannon to a knife fight to secure loyalty.
A perfect analogy.
Yep.
And we have two perfect examples of this extreme defensive spending. The first one involves Anthropic.
One of the leading generative AI players.
Right. So when Google agreed to provide Anthropic with up to 1 million TPUs,
which is a huge number.
A huge number. Nvidia's response was immediate and overwhelming.
What did they do?
They committed billions in new investments to Anthropic. And with that investment came a binding pledge from the AI startup to use Nvidia GPUs.
So they basically bought their loyalty back.
They effectively undercut Google's deal right out of the gate. That's a massive financial commitment just to hold on to one customer. It's strategic, defensive spending designed to bankrupt the competition through sheer volume of investment.
And the second example is even bigger, isn't it?
It's even bigger. So reports surfaced that OpenAI, the company that arguably started this entire generative AI revolution, was planning to rent TPUs from Google Cloud to diversify its massive computational needs.
And Hong's response?
He responded by striking a tentative $100 billion deal to help OpenAI build its own data center infrastructure.
100 billion, with a B.
$100 billion. That includes leasing them huge blocks of NVIDIA GPUs.
So wait, that is essentially paying your foundational customer a massive retainer, providing them the entire infrastructure they need just to prevent them from ever touching a rival's hardware.
Yes.
That's more than just competition. That's outright economic warfare.
It is. It's economic warfare waged to protect the core ecosystem. And this level of aggression reveals the existential threat that's posed by custom chips.
So Huang knows.
He knows that once a major player like Meta or OpenAI successfully migrates a significant portion of its workload to custom silicon like TPUs, they will never fully return to the high-margin, general-purpose GPU model.
The betrayal has successfully cracked Nvidia's defensive position.
It has. The fortress wall has been breached.
Okay. So the betrayal by Meta and the ensuing market shock, that immediately leads us to our next set of suspects. The institutional investors who seemed to know this crash was coming.
The accomplices.
The accomplices. We're
Yeah.
fixing on the massive, coordinated exodus of high-profile, influential investors, the smart money. What hidden fundamental risks were they sensing that triggered them to flee the stock?
Well, the alarm started sounding with Masayoshi Son and SoftBank. The Japanese tech conglomerate announced it sold off its entire Nvidia stake.
The entire thing.
The entire thing. Cashing out approximately $5.8 billion. This is not casual trading. This is a total exit by one of the largest technology investors in the world.
So what was their reasoning? I mean, publicly.
SoftBank executives offered a convenient narrative. They claimed the position was liquidated to fund massive new investments in OpenAI and a planned trillion-dollar AI manufacturing hub.
$1 trillion.
That's the plan.
Okay, so that motive, while convenient, actually confirms a crucial strategic point we were just discussing.
It does. They are moving away from betting on the chip provider, the infrastructure layer, and moving toward betting on the application and execution layer like OpenAI.
So they think the real money is now in the software that uses the chips, not the chips themselves.
Exactly. It's a vote of no confidence in the hardware growth trajectory.
But the narrative around Sun, it carries this undeniably troubling historical curse that we have to talk about.
We do. The SoftBank pattern of stock splits preceding major global market turmoil is, well, it's too consistent to ignore.
It's kind of chilling.
It's a very chilling pattern. So a stock split, 1-for-3, in June 2000, that preceded the dot-com bubble burst.
Okay.
Then a split, 1-for-3, in January 2006. That preceded the U.S. housing bubble burst.
I'm seeing a pattern here.
You got a split, 1-for-2, in June 2019, which preceded the global market tumble at the beginning of 2020.
And now?
Now, SoftBank just announced a 1-for-4 stock split plan, effective January 1st, 2026, coinciding with their complete divestment from the market leader.
It's almost a Cassandra effect. The timing. It strongly suggests that this move is not just opportunistic funding.
Not at all. It signals a deeper structural apprehension about the current market climate, especially around these inflated tech valuations.
And he wasn't the only one running for the door.
Not by a long shot. Following closely on SoftBank's heels was Peter Thiel, the venture capitalist titan known for his contrarian bets.
And his move was even more aggressive.
Right, it was a total divestment. It signals a fundamental verdict on Nvidia's valuation.
So tell us about the scale of that move. What exactly did Thiel do?
His fund, Thiel Macro, fully exited its Nvidia position in Q3 2025. They sold all 537,742 shares.
All of them.
All of them. Valued at nearly $100 million. Now, $100 million isn't SoftBank scale, obviously.
But it's significant because...
It's significant because those Nvidia holdings accounted for almost 40% of his fund's entire U.S. equity book before the sale.
40%. It was his biggest bet.
It was his largest concentration, and he eliminated it entirely.
And Thiel is explicitly clear about his rationale here. He's been warning about this publicly.
He has. He compares the AI spike directly to the 1999-2000 dot-com bubble crash. He sees valuations as fundamentally stretched beyond any realistic short-term possibility.
Can we quantify what he means by stretched? What do the numbers look
We
like?
can. At the time of the sales, Nvidia was trading at a trailing price-to-earnings, or PE, ratio of 54x.
54. Okay, put that in perspective for us.
To put 54x in perspective, traditional mega-cap tech companies like Apple or Microsoft, they typically trade between 25x and 35x PE.
So almost double.
Trading at 54x means the market expects Nvidia to grow almost twice as fast as those established giants, and do it indefinitely just to justify its current price.
And there's another metric that's even more telling, isn't there?
The EBITDA, the enterprise value to earnings before interest, taxes, depreciation, and amortization. It was 46.5x.
And that's bad.
It's a cleaner look at profitability, often used to gauge acquisition cost, and 46.5x it's astronomical. It is far, far above historical tech averages.
So when you combine those metrics, it really validates the smart money concerns.
It does.
Yeah.
The high PE implies a massive growth trajectory is already priced in, and the high EBITDA implies that even the underlying business structure is being priced for this extraordinary profitability that might not be sustainable.
Especially if competition like Google TPUs or efficiency like this DeepSeek we're going to talk about begins to erode those margins.
That's the fear.
But Thiel didn't just sell, he did something else, a strategic rotation. What did he rotate into, and what does that tell us about his thinking?
Well, he significantly reduced his overall U.S. equity exposure. His long U.S. stock book plummeted from $212 million to about $74.4 million.
So he pulled back from the market in general.
But he didn't abandon tech. He rotated into safer tech staples. He bought Apple and Microsoft.
Okay, so this isn't an anti-tech position.
No, it's an anti-unsustainable valuation position. Apple and Microsoft are decades-old, established firms. They have robust non-AI revenues and strong cash flows that act as a buffer against these speculative downturns.
So he de-risked.
He de-risked. He slashed riskier, highly valued growth positions like Tesla and exited positions in highly leveraged or speculative AI plays.
So if SoftBank's exit signaled the strategic shift towards software, Thiel's exit was a concrete mathematical valuation verdict.
That's a great way to put it.
And that rounds out this trio of bearish signals. We have the most famous bubble predictor of all, Michael Burry.
That's right. The investor
Active.
famous for predicting the 2008 crisis, the star of The Big Short.
And what did he do?
He disclosed heavy short positions on Nvidia.
He's betting against them.
A short position means he is actively betting that the stock price will drop sharply. He clearly believes that all the factors we're discussing, the competition, the stretched valuations, the efficiency threat, will converge and cause a sharp reversal.
So the combined message from Sun, Thiel, and Burry is just chilling.
It is. They're saying the AI stock rally is approaching bubble territory, and the market is pricing in more than reality can deliver in the short run.
They're essentially running for the exits and sounding the general alarm before the fire starts.
And this flight of smart money, it acts as a powerful accomplice to the initial volatility caused by Meta's betrayal. It pours gasoline on the fire.
Which brings us to our third and perhaps most insidious suspect, the silent killer.
Yes.
This threat is long-term and it's structural. It doesn't rely on selling a rival chip. It attacks the foundational assumption that AI training must always require ever-increasing amounts of outrageously expensive, high-margin hardware.
This is where the DeepSeek lab enters the scene. And they made a shocking efficiency claim that essentially turns the entire premise of AI training on its head.
And threatens Nvidia's profit margins in the most fundamental way possible.
That's it. So DeepSeek trained its massive 671 billion parameter language model using only 2,048 Nvidia H800 GPUs in about 2 months.
Okay, let's pause on the technical jargon for a moment because this is critical. What is a mixture of experts or MOE model?
That's a great question. So think of the MOE architecture as creating several smaller, specialized brains inside the AI.
Okay.
Instead of running the entire 671 billion parameters every single time you ask a question, the AI only wakes up the specific expert brain it needs for that particular task.
This is more efficient.
It allows the system to use far less energy overall, which leads to massive efficiency gains in both training and inference.
Okay, so they use a smart architecture, this MOE, but the real headline is the cost comparison and the efficiency claim.
Absolutely. DeepSeek claimed to achieve 10x higher efficiency than AI industry leaders like Meta. 10 times. And this translates directly into radical savings. Estimates suggest DeepSeek trained its huge model for roughly $6 million.
$6 million. Okay, compare that to...
Compare that to the estimated $80 million to $100 million spent on training foundational models like GPT-4.
Wow.
Which notoriously required 16,000 H100s. DeepSeek found a way to achieve comparable performance for a tiny fraction of the cost using significantly less hardware.
This cost collapse is the silent killer.
Yeah.
But we need to understand the weapon they used. How did they bypass Nvidia's protective fortress? This fortress we know as the CA moat.
This is the crux of the investigation. Nvidia's dominance isn't just about making the best hardware.
Right, it's the software.
It's protected by its proprietary software ecosystem, CE. CE is the software glue that makes programming their GPUs easy. It's been proprietary forever, and it acts as a massive lock-in mechanism.
So developers are kind of stuck.
They use CUA because it's convenient, it's well documented, and it works seamlessly with NVIDIA hardware. This convenience prevents customers from jumping ship to rival chips like AMD or custom ASICs because the software transition is extremely difficult and time-consuming.
So if the CVA moat is the defense, how did DeepSeek's engineers get across it?
They went mad scientist.
I like the sound of that.
DeepSeek's engineers achieved this efficiency by implementing these really fine-grained optimizations and using assembly like PTX, that's parallel thread execution programming.
Instead of just using the easy high-level CD.
Exactly. They didn't rely solely on CEA for some key functions.
So PTX is essentially getting down to the metal, right?
Yeah.
Talking to the hardware in its own low-level language. Why would they do that when CEAs is so much easier?
Because that low-level access allows for optimizations that the high-level software restricts. It lets them creatively overcome hardware bottlenecks. For instance, DeepSeek engineers reconfigured their H800 GPUs. They allocated around 20 of the streaming multiprocessors specifically for server-to-server communication, compression, and decompression.
Which normally isn't what they're used for.
No, this was a brilliant workaround to overcome the limited interconnect bandwidth on the H800s. They turned a weakness into a strength through sheer software finesse.
That's fascinating. So if they can make the chips they have work 10 times harder just by manually optimizing the software, the implication for Nvidia's profit structure is profound.
It is the ultimate structural threat. This breakthrough means AI developers can stretch their existing GPUs far, far further.
Which dramatically reduces the need for constant, massive, and expensive hardware upgrades.
Exactly. If the cost of training the next revolutionary model drops by 90%, the value shifts. It moves away from needing the $30,000 top-tier H100 GPU to effectively using the $3,000 GPU 10 times more efficiently.
And that severely limits Nvidia's margin leverage and threatens their core business model, which is selling ever more expensive hardware in ever larger quantities.
It's no wonder Nvidia's share price dropped 17% after the DeepSeek news broke.
The market got it immediately.
Investors recognize that if this efficiency becomes standard, the immediate need for hardware volume just drops off a cliff.
But there's a crucial counterargument here, right? Something often called the Moore's Law of AI.
Yes, and it's a very important one. Industry figures, including former Intel CEO Pat Gelsinger, argue that efficiency gains don't reduce total demand.
They enable new applications.
Precisely. They cite the personal computer revolution. As processing costs came down, volumes went up, leading to exponential adoption and new markets nobody could have predicted.
So the argument is that if AI gets 10 times cheaper to train, companies don't buy 10 times less hardware.
They just train models 10 times larger or launch 10 times more applications. The demand is elastic.
And do the spending figures support this counterargument? At least for now.
For now, they do. Despite the efficiency revelations, the largest data center buyers in the world, we're talking Microsoft, Google, Meta, and Amazon, they announced plans to spend hundreds of billions of dollars in 2025 on AI chips and data centers.
Hundreds of billions.
And that represents a near 50% increase over 2024's already record investment. The hyperscalers are essentially reinvesting all their efficiency gains toward improved overall performance and racing toward the next frontier. They are still very, very hungry.
Before we move on to the verdict, we have to look at the geopolitical angle of this silent killer. DeepSeek is a Chinese lab.
Right.
And their success, despite U.S. export controls on advanced chips like the H100, is a major event in the U.S.-China AI race.
It's a huge event. It demonstrates that comparable models can be built even with mandated handicaps.
They're working with one hand tied behind their back.
In a way, yes. DeepSeek's CEO has described the bans on advanced chips as the greatest challenge facing his company. He said it forces them to use 2 to 4 times the computing power compared to the unfettered H100s used by U.S. labs.
But necessity is the mother of invention.
And that desperation drove the algorithmic innovation that might now undermine the dominant Western firm.
This success also raises massive questions about intellectual property, or IP, protection in AI research. Specifically, the concern over something called distillation.
That's the core IP concern here. Distillation is a technique where a larger, complex model, the teacher, transfers its accumulated knowledge and skill to a smaller, more efficient version, the student.
Okay, so it's a form of knowledge transfer.
Exactly. And U.S. firms like OpenAI are reviewing indications that DeepSeek may have inappropriately distilled their models. In other words, capturing the R&D benefits without bearing the astronomical costs.
This sounds a lot like the pharmaceutical industry, doesn't it?
It does, and that structural parallel is terrifying for AI labs. In pharma, R&D costs billions and can take over a decade to develop a new drug.
But once the patent expires,
Generic manufacturers can reproduce the drug for a tiny fraction of the cost. If frontier AI model research follows that same pattern, extremely high upfront R&D costs but very low replication or copying costs via distillation, the competitive advantage shifts entirely.
So in that environment, the advantage moves away from who has the smartest software engineers writing the best algorithms.
And it moves toward pure hardware manufacturing capacity and IP enforcement.
Which brings us full circle back to Meta.
Exactly. If the structural knowledge leakage caused by techniques like DeepSeek's PTX optimization and a potential distillation becomes widespread, the proprietary AI software advantage dies. And if you can't protect your software IP, the entire race shifts to who can build the most hardware, the fastest, and the cheapest.
That's why Meta's push for custom TPUs is so significant. They're preparing for that future.
We're playing the long game.
Okay, we've laid out the facts of the case. We have the betrayal by Meta cracking the market open. We have the flight of the smart money confirming the valuations were stretched. And we have the emergence of this efficiency killer threatening Nvidia's structural margins.
The three suspects.
Now, we have to synthesize this evidence and ask the final central question. Is this just a bad quarter, or are we reliving the 1999 catastrophe?
There are undeniable red flags. I mean, echoes of the dot-com era that should terrify any investor. We have to start with the sheer valuation madness engulfing startups.
Investors are just plowing money into AI startups, often with modest revenues or no revenues at all.
We're seeing astronomical multiples. Some of these AI startups are being valued at hundreds of millions per employee.
That's a scale of exuberance not even seen in the late 1990s. We're seeing companies raising capital based purely on potential, not profitability.
And this funding blindness is pervasive. You have companies that often lack clear, scalable revenue models, but they raise enormous sums of money based on this broad expectation of industry upheaval. It's very much like the untested business models of the dot-com era.
Where famously over 85% of those new firms eventually went bust.
And investment pioneers are openly sounding the alarm. You have Rob Arnott, for instance, who called the AI hype a classic example of a big market delusion.
So the red flags, the valuation stress, the speculative funding, the historical pattern of SoftBank, they all scream bubble.
They do.
But if we disaggregate the data, we find crucial differences that suggest this might not be an exact replay of 2000. So why might this boom survive?
I think the maturity of the incumbents is the most crucial difference.
How so?
Unlike the dot-com mania, which was filled with nascent cash-burning startups, most of today's big players, Microsoft, Google, Amazon, Nvidia, are decades-old established firms.
They have real businesses underneath the hype.
They have diversified revenue streams, strong cash flows, and sustaining non-AI businesses. If the AI investment slows down, they have enormous buffers to withstand the shock. The dot-com startups simply didn't possess that.
And secondly, the nature of the investment itself is different, right?
Yeah.
This potential bubble is heavily capital expenditure driven, CapEx driven.
Exactly. In the 1990s, money went into, marketing gimmicks and flimsy business plans, Super Bowl ads for companies that sold nothing.
Today's investment is going into durable physical assets. State-of-the-art data centers, incredibly complex GPU clusters, fiber networks, power infrastructure.
These investments yield real, tangible productivity gains across industries. Even if the valuations of AI software firms collapse, the physical infrastructure built by Microsoft or Google still holds intrinsic value and utility. It's a physical, legitimate, structural element to this boom.
And finally, we have a strategic commitment that goes beyond pure market forces. AI is now squarely on national policy agendas.
From the U.S. Executive Office to the EU's comprehensive AI laws.
This is critical, isn't it?
It is. Governments view AI leadership as a matter of national security, military capability, and future economic supremacy.
So they're not going to let it fail.
That strategic commitment implies that major nations will likely continue to funnel massive capital into the core technology, preventing a total collapse in the large players who are essential to maintaining that strategic edge.
So if we synthesize all the evidence, the structural threat of efficiency, the flight of the smart money, but also the strength of the incumbents and the physical CapEx, what's the most realistic verdict here?
The consensus view is nuanced. You can credibly argue that AI is partly a bubble in valuations and speculative derivatives, but is also a legitimate structural technology supercycle. The biggest risk lies not in the collapse of the underlying technology itself, but in the unsustainable projections and valuations of the new AI entrants and startups.
The ones burning billions without clear profits.
Those are the ones at risk.
So the most realistic outcome is not a 1929-style catastrophe, but what analysts are calling a digestion moment.
Precisely. It's a market repricing, a harsh shakeout where the frothiest segments get severely punished, forcing investors to be highly selective, to focus on quality, large-cap names.
So the air is definitely starting to leak out of the most frothy segments.
But the fundamental engines of AI development, the massive spending by the hyperscalers, will continue to run, albeit with tighter margins for the chip suppliers.
And the synthesis shows how the three suspects we identified actually interacted to cause this shock.
Absolutely. The betrayal, the Meta-Google deal, that provided the initial shock and confirmed the volatility.
Then the flight of smart money.
Thiel and SoftBank. That validated the stress, signaling that the valuation fear was legitimate. And the silent killer, DeepSeek's efficiency, provided the structural justification for the entire drop.
Confirming that long-term margin erosion for hardware providers is a real, tangible possibility.
They all work together.
So we've uncovered the players responsible for the recent volatility and the structural pressures mounting against the hardware king. The immediate shock to Nvidia was triggered by that Meta-Google betrayal and the flight of smart money.
Both signaling high valuation stress and a move toward diversification.
And the long-term threat to Nvidia's incredible profit margins is DeepSeek's efficiency attack. By going below the CADA moat and optimizing with PTX, they proved that models can be trained far, far cheaper.
And while this challenges NVIDIA's immediate profitability, you have to remember that by lowering the barrier to entry, it may ultimately expand the total market by accelerating new AI applications.
So the final verdict remains complex. We are not in an exact 1999 replay, mainly because of the strength of the incumbents and the tangible capex being deployed. But perfection is currently priced in.
And any news short of flawless execution will continue to trigger massive volatility.
This leads us to the final provocative question for you, the listener, to mull over.
If DeepSeek's algorithmic innovations are now adopted by U.S. firms that have access to superior compute, like the next generation of NVIDIA's Blackwell and Rubin chips, will this structural knowledge leakage lead to the death of the proprietary AI software advantage?
And if that software moat fails, does the true competitive race become entirely about hardware manufacturing capacity, cost control, and IP enforcement?
The critical signal you should be watching for next is not just whether companies keep announcing chip purchases.
It's whether they start pulling back on AI hiring and capital spending. A sustained corporate pullback, which we've noted already at some firms like Alibaba and even Meta in some areas, that would signal a plateau in the underlying business commitment.
And that would confirm that the speculative bubble has finally burst the fundamental engine of growth.